Somewhere in the Mediterranean, circa 1750 BCE, a merchant's entire fortune rides on this ship. 3 years of profit, his family's future, his children's inheritance, one storm, one miscalculation, one moment of bad luck, and everything disappears beneath the waves. This is the fundamental problem of human civilization. We build, we create, we accumulate, and then, in an instant, it can all vanish. Fire destroys your home, disease kills your livestock, pirates seize your cargo, drought ruins your harvest, death takes the family breadwinner. For most of human history, when disaster struck, you simply suffered. You started over, or you didn't. There was no safety net, no guarantee, no protection. And then about 4,000 years ago, someone had a radical idea. Babylon, the jewel of Mesopotamia, a city of perhaps 200,000 people, built on trade, law, and written contracts. In 1750 BCE, King Hammurabi codified 282 laws into stone, the Code of Hammurabi, one of humanity's first comprehensive legal systems. Most people know it for an eye, but buried among laws about property rights and criminal justice was something far more revolutionary. Law 238 stated, if a shipmaster loses a merchant's ship but saves the cargo, the shipmaster must replace the ship. Law 240. If a moving ship hits a stationary ship and sinks it, the owner of the moving ship must replace everything lost. These weren't just liability laws, they were the first recorded instances of risk transfer. The idea that one party could assume the financial burden of another party's potential loss. But Hammurabi's code went further. Babylonian merchants developed something called bottomry contracts. Here's how it worked. A merchant needed to ship goods across dangerous waters. He would borrow money from a lender, essentially a loan secured against the ship and cargo. If the ship arrived safely, the merchant repaid the loan with substantial interest, sometimes 30 to 50%. But here's the crucial innovation. If the ship sank, the loan was forgiven. The merchant lost his cargo, but not his future. The lender had effectively insured the voyage. In exchange for high interest, they absorbed the risk of total loss. They were betting on safe passage. The merchant was buying protection against catastrophe. This was insurance, 4,000 years ago. Written in clay, sealed with cylinder stamps, the concept would spread across the ancient world, but it would take another 3,000 years to truly formalize. Rome built an empire on logistics, moving grain from Egypt to feed 1 million Romans, transporting marble from Greece, shipping wine from Gaul, and where there's commerce, there's risk. Rome formalized many concepts the Babylonians had pioneered. Roman law introduced Collegia, mutual aid societies where members pooled resources to cover funeral expenses, support widows, and aid families when breadwinners died. Pay in regularly when times are good. Draw out when disaster strikes. It's the fundamental mathematics of insurance. Many pay for the misfortunes of the few. The Romans also refined maritime insurance, creating detailed contracts that specified exactly what perils were covered. Storms? Yes. Pirates? Yes. War? Negotiable. Crew incompetence? Excluded. These distinctions matter. Because insurance isn't really about preventing disaster, it's about defining who pays when disaster strikes. But Roman insurance had a fatal flaw. It relied entirely on personal relationships and reputation. There was no regulatory framework, no guaranteed enforcement across borders. When the Western Roman Empire collapsed in 476 CE, much of this institutional knowledge collapsed with it. The Mediterranean fractured into competing kingdoms. Long-distance trade contracted, the need for sophisticated insurance temporarily disappeared. The knowledge didn't die, it simply waited. In monastery libraries, in Byzantine legal codes, in the muscle memory of merchants who never stopped trading, waiting for the next great age of commerce. Venice, Genoa, Florence, Pisa, the Italian city-states that rebuilt Mediterranean trade in the Middle Ages, and with renewed trade came renewed risk. The Venetians, masters of commerce, resurrected and refined the ancient insurance contracts. In 1347, the earliest surviving marine insurance contract was written in Genoa. It insured a ship traveling from Genoa to Majorca, carrying a cargo of wheat. The premium was 18% of the cargo's value, high by modern standards, but reasonable for medieval sea travel where perhaps 1 in 10 ships didn't return. The Italians innovated beyond simple risk transfer. They created the underwriter. The term comes from the practice of writing your name under the insurance contract, followed by the percentage of risk you were willing to assume. Multiple underwriters would share a single risk. One might take 10%, another 20%, a third 15%. Together they spread the potential loss across many shoulders. This was the birth of the modern insurance syndicate. The realization that even catastrophic risks become manageable when properly distributed. But maritime insurance was still informal, unregulated, vulnerable to fraud. What the industry needed was standardization, enforcement, legitimacy. What it needed was London. London, 1686. The city is rebuilding after the Great Fire 20 years earlier. Trade is exploding. The British Empire is expanding. And in a modest coffeehouse on Tower Street, the modern insurance industry is about to be born. Edward Lloyd ran a coffeehouse. Nothing special. But he did something clever. He provided reliable shipping information, which ships had arrived, which had departed, which were overdue, what cargo they carried. Merchants, ship captains, and investors gathered at Lloyd's not just for coffee, but for information. And where information concentrates, opportunity follows. Ship owners began seeking investors to insure their voyages. Wealthy individuals began offering to underwrite risks. Lloyd's coffeehouse became the marketplace where risk was bought and sold. Edward Lloyd died in 1713, but his coffeehouse lived on. The underwriters who gathered there formalized their operations, creating Lloyd's of London, still the world's most famous insurance market 300 years later. But Lloyd's specialized in maritime risk. What about everything else? What about the homes being built, the businesses opening, the ordinary people who also faced disaster? September 2nd, 1666. A baker's oven in Pudding Lane ignites a fire that will burn for 4 days. 13,000 houses destroyed, 87 churches, most of the city of London reduced to ash, 70,000 of the city's 80,000 residents left homeless. The financial loss was catastrophic. An estimated £10 million, roughly $2 billion in today's money. Losses that fell entirely on property owners. There was no compensation, no relief. You simply lost everything. Unless you were extraordinarily wealthy, you couldn't rebuild. Families that had been prosperous for generations were ruined overnight. The Great Fire taught London a brutal lesson. Individual savings can't protect against catastrophic loss. You need shared risk. In 1681, economist Nicholas Barbon founded the first fire insurance company in England, the Insurance Office for Houses. For a premium calculated on your home's value and construction materials, Barbon's company would rebuild your house if it burned. For the first time, ordinary property owners could transfer catastrophic risk to an institution. Insured buildings displayed metal fire marks, plaques identifying which insurance company covered them. When fire broke out, private fire brigades would check for their company's mark before fighting the flames. If your building had the wrong company's mark, or no mark at all, you were on your own. Capitalism is efficient. It's rarely kind. Still, fire insurance caught on. Within 20 years, multiple companies competed in London. The concept spread across Europe, then to the American colonies. Insurance was becoming normal, expected, a standard part of commercial and domestic life. But the biggest innovation was still to come, and it would emerge from the intersection of insurance and mathematics. Edmond Halley, yes, the man with the comet, was also a mathematician who became obsessed with a morbid question. Can you predict when people will die? Not individuals, of course, but populations. If you study enough births and deaths, do patterns emerge? Using death records from the city of Breslau in Silesia, Halley constructed the first proper mortality table, a statistical model showing the probability of death at any given age. At age 20, you have a certain probability of reaching 30. At age 30, a different probability of reaching 40. These probabilities could be calculated, quantified, turned into numbers. And if you can quantify the risk of death, you can price it. You can sell protection against it. You can sell life insurance. In 1762, the Equitable Life Assurance Society became the first company to offer life insurance based on actuarial science rather than guesswork. Your premium depended on your age and health. A 25-year-old paid less than a 50-year-old because statistically, they were less likely to die soon. The mathematics were ruthless, and they worked. Thousands paid small amounts regularly. When someone died, their family received a payout, funded by everyone's contributions. The many subsidized the unlucky few. It was beautiful, in a cold mathematical way. Risk transformed into spreadsheets, mortality converted to profit margins. Life insurance changed society in ways its inventors never anticipated. For the first time in history, ordinary people could guarantee their families wouldn't be destitute when they died. Widows and orphans who would have faced poverty now received payouts. Debts could be settled, futures could be secured. Death was still inevitable. But financial ruin became optional. The 19th century was the century of risk multiplication. Factories introduced industrial accidents, railways created new forms of liability, cities crowded with people created public health hazards, and for every new risk, someone invented insurance to cover it. Health insurance, accident insurance, employer liability insurance, crop insurance, theft insurance, boiler explosion insurance. By 1900, you could insure almost anything, and people did. Insurance companies became some of the most powerful financial institutions in the world. They collected vast sums in premiums, invested them, and grew wealthier than banks. The Prudential, MetLife, AIG, these weren't just companies. They were institutions that held the pooled risk of entire nations. By 1950, the global insurance industry managed trillions in assets. They financed highways, buildings, infrastructure. They became too big to fail, which meant when they did fail, entire economies trembled. Today, insurance is everywhere, mandatory in many cases. Car insurance, health insurance, home insurance, life insurance. We pay thousands of dollars annually for protection against events that probably won't happen. It's the reverse lottery. We gamble on misfortune, hoping to lose the bet. The mathematics haven't changed since Edmond Halley's mortality tables in 1693. Many pay small amounts, few receive large payouts. The house always wins in aggregate. But here's the paradox. We resent paying for insurance, yet we panic without it. A serious illness in America without health insurance can cost hundreds of thousands of dollars. A single car accident without liability coverage can destroy your financial future. We've created a world where insurance isn't optional. It's essential. Where going uninsured is reckless. Where the question isn't whether to buy insurance, but which insurance to buy. And insurance companies know this. They've learned to price risk with extraordinary precision, using algorithms that know more about your health, habits, and history than you do. Your premiums aren't random. They're calculated from thousands of data points. Your age, your occupation, your zip code, your credit score, your online shopping habits. Insurance has become surveillance. Protection requires disclosure. Privacy is the price of coverage. But the insurance model has a fatal vulnerability. It was built on the assumption that the future resembles the past. That risk is predictable. That historical data forecasts future loss. What happens when that assumption breaks down? In 2023, major insurers began abandoning entire markets. State Farm and Allstate stopped offering new home insurance policies in California, citing wildfire risk. In Florida, Louisiana, and other hurricane-prone states, private insurance is disappearing, replaced by state-run programs that can't afford the payouts when disaster strikes. The mathematics that made insurance possible are breaking down. When disasters become frequent instead of rare, when losses become predictable instead of random, the model collapses. You can't insure against certainty. You can only insure against probability. And climate change is converting improbable catastrophes into inevitable events. The insurance industry is facing an existential crisis, and it's responding with technology that would seem like magic to those Babylonian merchants 4,000 years ago. Parametric insurance that pays out automatically when sensors detect specific conditions. Earthquake magnitude, rainfall levels, temperature thresholds. No need for claim adjusters. The data triggers payment. Peer-to-peer insurance platforms using blockchain, where groups self-insure without traditional companies taking profits. AI-powered risk assessment that can predict your health outcomes with disturbing accuracy, pricing insurance down to the individual rather than the group. This creates new problems. If insurance becomes perfectly personalized, it stops being insurance. It becomes a prediction of your individual future. The whole point of insurance is to spread individual risk across a pool. But if technology can identify exactly who will get sick, who will crash their car, who will file claims, then the healthy subsidizing the sick, the safe subsidizing the reckless, the lucky subsidizing the unlucky, all of that breaks down. You're left with perfect information and no solidarity. Each person priced according to their exact risk, which isn't really insurance anymore, it's just accounting. Strip away the mathematics, the premiums, the policies, and insurance is fundamentally a moral proposition. It says, we are responsible for each other's misfortune, not out of charity, but out of recognition that fortune is random and disaster is universal. The healthy pay for the sick, because someday they will be sick. The safe pay for the reckless, because someday they will make a mistake. The fortunate pay for the unfortunate, because fortune changes. Insurance is formalized compassion. It's empathy, converted into spreadsheets. It's the recognition that we're all one bad day away from catastrophe. But it's also profitable compassion. Insurance companies exist to make money. They price risk to ensure the house wins. They deny claims. They fight payouts. They optimize for profit, not protection. The tension between insurance as social good and insurance as profit-seeking business has never been resolved. Perhaps it can't be. From Hammurabi's code to Lloyd's coffeehouse to AI-powered risk algorithms, insurance has been humanity's attempt to tame randomness, to build a bulwark against chaos, to create certainty in an uncertain world. It hasn't eliminated risk, it can't. Risk is fundamental to existence, but it is distributed risk, spread it across time and populations, made catastrophic loss survivable. Right now, you are probably insured. Your health, your car, your home, maybe your life. Pieces of paper or digital documents that promise if disaster strikes, you won't face it alone. You pay for this protection grudgingly. The premiums feel like waste, until suddenly they're not. Until the fire, the accident, the diagnosis, the disaster. And then those premiums become the best money you ever spent. Because insurance doesn't prevent tragedy, it just prevents tragedy from becoming permanent ruin. From ancient Babylon to modern algorithms, from clay tablets to blockchain, the fundamental insight remains unchanged. Individually, we are vulnerable. Collectively, we are resilient. Alone, catastrophe destroys us. Together, catastrophe becomes manageable. Insurance is the formalization of that simple truth. It's the contract that says, your disaster is my concern. My disaster is your concern. We are bound by mutual vulnerability. Today, over $7 trillion in insurance premiums are collected globally each year. Trillions more sit in reserves, waiting to cover claims. It's one of humanity's largest cooperative enterprises, an invisible infrastructure that makes modern life possible. We drive cars knowing accidents are covered. We buy homes knowing fires are insured. We start businesses knowing failure won't mean destitution. We live boldly because someone else has agreed to absorb our worst-case scenarios. For a price, of course. There's always a price. But that price, those begrudged premiums, might be the cost of civilization itself, the cost of not facing disaster alone. If this journey from ancient Babylon to modern insurance fascinated you, you've found the right channel. This is what we do at the Fascinating Origins of Things. We uncover the hidden histories behind the everyday systems, objects, and ideas you take for granted. Insurance, banking, corporations, money, law. Every mundane system has an extraordinary origin. Every boring adult thing was once a revolutionary idea. If you enjoyed this deep dive into insurance's 4,000-year history, I need you to do 3 things. 1. Hit that like button. YouTube's algorithm needs to know that detailed, researched historical documentaries matter. That stories this complex deserve to be told.